Everyone thinks the panic of 1873 was just bad luck. It wasn't, it was engineered. The accepted story goes like this: America's railroad boom was unstoppable. Investors poured fortunes into rail bonds because trains were the future. Then suddenly Jay Cooke Company, the nation's most trusted banking house, collapsed in September 1873. The dominoes fell, stock markets crashed, banks failed, unemployment soared, a decade-long depression followed. Simple cause, dramatic effect. Except that's only half the picture. Between 1865 and 1873, railroad companies issued bonds at an almost frenzied pace. These weren't stocks, they were debt instruments backed by rail assets and future revenue. Investors, especially wealthy ones, treated them like the safest bet in America. Why? Because railroads literally built the nation's infrastructure. They connected cities, moved goods, enabled westward expansion. The logic seemed bulletproof. But here's where the machinery cracks. Not all railroads were profitable. Many were speculative ventures into territories with little current demand. Yet bond prices kept climbing. Why? Because Jay Cooke himself, a Philadelphia banker with enormous influence, had become the primary distributor of Northern Pacific Railroad bonds. He marketed them aggressively, even to small investors. His reputation was the collateral, not the rail company's actual earnings. By 1873, Northern Pacific had spent enormous sums laying track through barely populated regions. Revenue wasn't materializing. The bond market, already saturated, began losing confidence. On September 18, Jay Cooke Company announced it couldn't meet its obligations. The announcement hit like a lightning strike. If Cooke, the man whose name meant financial stability, could fail, who was safe? Within days, panic selling erupted. Investors rushed to dump railroad bonds, which nobody wanted anymore. Stock exchanges closed. Banks that had invested heavily in rail debt faced a liquidity crisis. They had assets but couldn't sell them. Credit froze. The real economy seized up. Factories shut down. Workers were laid off. Unemployment hit 14% by 1874. So what's the real explanation? The panic wasn't random. It was the inevitable collapse of a speculative bubble inflated by reputation, not fundamentals. Railroad bonds looked safe because Cooke said they were safe. Investors didn't scrutinize actual earnings, they trusted the banker's name. When reality, unprofitable rail lines, finally caught up with price, the illusion shattered. The system had mistaken confidence for value. That's why the panic of 1873 matters today. It wasn't about trains being a bad investment. It was about what happens when intermediaries, bankers, brokers, trusted institutions substitute their reputation for actual due diligence. The cost, a 6-year depression, millions of lost jobs, and a lesson the market would forget, then relearn over and over again. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the hidden patterns behind history's greatest financial collapses, new cases every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.